Hi guys, let's talk house. How much house? When we bought our home, we really thought about that fundamental question that we all think about. How much house can we afford on our current income, and how can we avoid the stress and pressure of carrying a large debt? So let's run through some of that basic personal finance prudence when thinking about how much home to buy. If you've done your research, the common and conservative advice is that you should limit your expenditure on housing to about 30% of your gross national income. Working on averages in the UK, that would mean that the average salary is at, say, 30k and average home prices at 245k, you would need to borrow around 35 years to make the numbers work. It can be done, but it is a little bit tight. So in this video, I want to chat through step by step how much you should be spending on your housing and avoid becoming house poor. And I want to say house poor is when your housing costs are too high relative to your income, and so you'll struggle to save or pay money towards other financial goals, and it's not a great feeling. So the main point around this is sticking to about 30% of your gross income, which leaves a good amount for you to budget on life, really. And guys, there's no misconceptions out there. Owning a home is an expensive business. The excitement of buying a house and owning a home is a powerful draw, and one that we often don't really think about all the other costs that go into home ownership. For example, as if some of you have been watching my videos, one of my bathroom ceilings collapsed last week and my house was messed up for about a week. When you own your own home, there's no landlord to call to fix it. As well as the unexpected costs like a ceiling collapse and of course the mortgage costs, there are other costs such as building insurance, home insurance, life insurance, taxes, council and stamp, maintenance, like for example a collapsed roof, and last year it was the boiler, renovations and upgrades, utilities, service and ground rent charges if you're buying a flat, and probably a few more. So it is slightly like cracking open a can of worms, if you like. But let's cover some of the most important costs in a little bit more detail. The first one being the mortgage cost. The mortgage itself is a financing cost, which means there are three elements that make up the equation. The first is the principal, which is the amount that you borrow, and the second is the financing rate, which is the interest rate, and finally the amortization period, or in layman terms, it's the length of the mortgage in years. So if we break it down into really simple terms, the mortgage amount is the cost of the house minus the deposit, which is equal to the mortgaged amount. Interest rates themselves are determined primarily by central banks, as banks that lend to us would borrow money centrally. However, the UK base rate is currently 0.1%, while the average UK interest rate on mortgages is about 2.67%, and that is a big markup. And what drives that essentially is the risk considerations that come in and the pricing that is at a premium to cover all eventualities. So when you apply for a mortgage, the bank will be interested in seeing how likely you are to repay that loan, but judging also the affordability, but also the financial responsibility and prudence, like the economic situation and if it will impact your job or your credit history. Another factor is if you have kids, and another factor is you subscribe to my channel. Just kidding, guys. So the amortization rate then itself is how long you have the mortgage. So in prior generations, maybe say for example my parents' generation, those loan durations were much shorter. Now with the booming house prices and also the population living a lot longer, it's not really uncommon to see mortgages offered at about 30 plus years. Our own mortgage on this house is 35 years, and that's pretty depressing if you think about it. Going back to that example, with the average UK prices, if we borrowed about 90% of 245k, which is 220.5 at 2.67 for about 35 years, your monthly cost would be £808. And if you're up on the averages, then that would make up about 32% of your gross income of 30k, if that was your average salary. Insurance, taxes, maintenance costs, like I mentioned before, in the UK that they're pretty difficult to provide general rule of thumbs on, so I'm going to avoid that. But we do have a great resource in zoopla.com, which provides a breakdown of various utilities, taxes that we should actually consider when thinking about a property. Our council taxes, if you ask me, are calculated on a very archaic home, guys, and insurance can pretty much depend on the area you decide to live in, your life circumstances. I pay a couple of £100 for insurance a year and a couple of thousand for council tax a year, and that's just a very sort of rough quantum, so you get an idea. The next thing I want to talk about is maintenance, and that is a tough one, and our friends across the pond in the US suggest a 1% home value as an estimate to sort of cover the annual insurance, taxes and maintenance. I think that is a little bit prudent. Personally, I have a in case things happen budget for my home, and I pretty much limit it to about 1k. I could have damage that exceeds that and maintenance costs that exceed that, in which case then I will need to go into my emergency budget. So I think that 1% rule is pretty good when creating a budget, and so that would typically look like your home value multiplied by 1% minus the home insurance minus the council tax, and that is equal to your maintenance amount. Home insurance and council tax you will know with certainty. Right, let's talk utility bills. In the UK, the big ones are gas, water and electric. The gas and electric average is about £1,300 a year. The average water bills are about £375 a year, and broadband is averaging around £240 a year. So in total, utilities for the home come just under about 2k a year, or £165 per month, and that all builds up, guys. So how much can you actually afford? Let's run through a checklist to see if you can afford a house, and this is where the juicy bits come in. So firstly, find the estimated monthly mortgage for the house you're thinking of buying, and find the annual mortgage payment, which is made up of the repayment and the interest, and this is all about the affordability. Add your stamp duty to that. This will vary across the UK, but for the average price example that we're thinking about, it's currently 0, which is awesome if you're thinking about buying right now. Then you add 1% for maintenance, insurance and council tax based on what we just discussed, and 2k per annum for utilities. Add all the numbers from 1 to 4. I feel like I'm telling you a recipe, but honestly, but this does work and will give you a good indication. So like I was saying, add all the numbers from those steps, and then take your gross income, the money that you bring home, and divide that by that particular number. Just look at the example again. So going back to that house that costs 245k with a £808 per month mortgage payment, you add 0 for stamp, you add about £2,450 for maintenance and insurance, and on top of that you add £2,000 for utilities. So the total annually will be 14,146 for an average income of about 30k, and that's about 50% of that average salary. And in fact, to buy the average home in the UK, the numbers do suggest that you need to be on a minimum salary of about £47,150. To buy an average home in the UK, you need to be earning 60% more than the national average. So what now? Well, there are two thoughts then. Don't fall into the trap of being house poor. Owning a home can increase your net worth, but there is an incredible concentration of risk of having all your eggs under one basket, and there are numerous issues in the UK around that. One of the most important things that you will consider is capital growth in your home, and when you do it, it does come at a cost. So the main points are: the more you spend on a house, the less you have to save. And as you approach retirement and your home is a bulk of your net worth, then financial security is kind of put at risk, and liquidating your home for cash flow is difficult both emotionally and economically. And owning your home is a great achievement, don't get me wrong, but having too much home can prevent you from building wealth and providing true security. So the question is, how do we optimize it? And I love this bit. The averages have shown us that going in on your own is a tough gig. However, two things I talk about in my other videos is the power of leverage, and also why owning your own home can be a powerful experience, with a little bit more detail on renting versus buying, and also hacking, guys, from my cringe binge collection when I first started this YouTube thing. And if you're interested in seeing those little snips, I'll pop the links right here and see you there.